This is the Human Action Podcast with your hosts, Jeff Deist and Dr. Bob Murphy.
Ladies and gentlemen, welcome back once again to the Human Action Podcast. As always, I'm joined by my co-host, Dr. Professor Bob Murphy. How you doing, Bob?
I'm doing great, Jeff. How are you?
Well, so we agreed this week that we would talk about inflation. It's a hard topic to ignore given that we've got these new March CPI numbers year over year. Basic CPI up 8.5%, gas 48%, electricity 11%, meat, poultry, and fish 13.8%, milk, coffee, used cars, etc. Airline fares up 23%. It goes on and on. So it's a hard topic to ignore, but I wanted to talk a little bit more about inflation from an Austrian perspective because there's a lot of misinformation out there. There's just a lot of Johnny-come-latelys in the mainstream media, in the financial press who are now, worrying about inflation and talking about it. They don't really get it right for the most part. But I also wanted our audience to hear a little bit about how you get out of inflation, how you end it. Because other than Jerome Powell, who seems to talk about this, I don't really hear too many people offering solutions. And they're not necessarily easy or quick or painless. But nonetheless, Bob, it's a political matter, if nothing else. This is getting pretty serious for old Joe Biden. I mean, this really feels like things are unraveling.
Yeah, I think so. And it's interesting because this wasn't anticipated. Like I was digging up some stuff just last summer. Paul Krugman had an article that the New York Times put a headline of the weak inflation panic died. And he starts out saying, remember when everyone was panicking about inflation, warning ominously about 1970s type of stagflation? For those paying close attention, the inflation panic, is so last week. And that was in June of 2021 when inflation was at 4.9%, CPI. So
Wow.
You're right. A lot of people so it's useful to recall that kind of stuff because as it kept ratcheting higher and higher month after month, lots of mainstream economists and other pundits were saying, okay, yeah, we've seen the worst of it. This is just supply side bottlenecks, from the pandemic and stuff. This will go away. And obviously it just kept ratcheting higher. So you're right. I think a lot of people, since they didn't see this coming, they don't know what to do about it. They're still kind of caught flummoxed. Yeah,
it's remarkable, though. They still listen to Paul Krugman. I mean, it's tempting to go find that article and tweet it and say, oh, ho, 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 here's Paul Krugman less than a year ago telling us that this was all fine.
Oh, I did tweet it.
Well, see, there you go.
I was tempted and succumbed to the temptation.
It just goes to show you that Twitter, wants to enforce our dopamine hit with that little bit, knife twisting. But I mean, I guess let's go back real quickly and just start with some basics since 2020. Remember that old world of January 2020 before COVID? It seems like a lifetime ago. So, if we're trying to tease out or understand inflation in a more concrete way than the mainstream press gives us, all we have to do for starters, without getting into the Fed and interest rates and all that stuff, I mean, if we just look at what they call broad money, the M3 money supply, it was about 15.4 trillion with a T. In early 2020, it's currently about 21 or 22 trillion with a T. That's a 36% increase, folks. And this is money in currency, checking accounts, money market accounts, very short-term bonds. This money is not magic. It's out there. For those who wish to recall, we can go back. Remember when Donald Trump was president and they passed that miserable $2 trillion CARES Act in March of 2020. This is what Congress does. Whenever there's a crisis or an emergency like 9/11 or a virus, they respond by doing the only thing they know how to do, which is spend money. So that was about $2 trillion direct to businesses, folks. PPP loans, local governments got $150 billion, $25 billion to the airlines. Remember, the airlines have more cash now than before the flying shutdown. $500 billion loans to corporations, $1,400 or $1,200 stimulus checks. Okay, you put all that in a blender, it's $2 trillion. And then you fast forward to Biden being in office in 2021, the American Rescue Plan, again, another $2 trillion. They continued with the $300 weekly unemployment benefits from the federal government. another $86 billion to pension funds, another $350 billion to state and local governments. So again, there's $4 trillion right there in real money that's reflected in M3. So that alone, all other things equal, would seem to explain at least some of this.
Right. And it's, you can look at various measures. Yeah, you look at whether it's M1, M2. And I should just caution people because they did a redefinition. It's an arcane matter. It's not worth getting into. In my book, Understanding Money Mechanics, I spell it out. That's available at Mises.org, folks, if you care to see the details. But there is a jump in M1 that's more than it's partly because of a redefinition. But even if you use the old, consistent definitions, still even M1, M2, they all went up significantly since 2020. So yes, Jeff, you're right that money in the hands of the public, and again, this isn't because what happened after the financial crisis with all the rounds of QE is there was a huge increase in bank reserves. Even there, M1 and M2 did go up somewhat, but not as much. Whereas, yes, this time around, you see the same pattern, and again, money in the hands of the public. So I want to just caution people: don't think that, oh yeah, but that money was just all bottled up in the system or something. The banks were sitting on it. That no, this is these definitions we're using is money that the public has the ability to spend, and yes, those are way up, and so it shouldn't be a surprise, especially when coupled with supply bottlenecks, that you're going to see rising prices.
So the corrective to this seems to be for the Fed to raise interest rates. That's what we hear over and over again, is that the Fed is going to finally start tapering off its balance sheet, it's to stop buying assets, which it's done during the last two crises of COVID and the crash of 2007. And it's going to start raising interest rates. So we hear this euphemistically. What they really mean is targeting a higher Fed funds rate. So Bob, just walk us through that. First of all, what's the Fed funds rate? What does it mean when they try to raise interest rates? And I'm not convinced that raising interest rates is going to do anything about inflation at all.
Okay, sure. So you're right. When they talk about the Fed raised rates or changed its target, for a long time, what that's meant in practice was the federal funds rate, and that is the interest rate that banks charge each other for overnight loans of reserves. Okay, so it's the bank's interest rates for each other for overnight loans, and then that's kind of a benchmark. And one way to think about it is, since those are pretty safe loans, that anything that consumers get is going to obviously be higher than that. So if the federal funds rate goes up, then presumably other kinds of interest rates are going to go up too. Now, so historically, and up until 2008, the idea of the Fed raising rates tended to be the same thing as saying the Fed's tightening, other things equal, because the way the Fed would raise rates, if they changed the target for the federal funds rate, is they would suck reserves out of the system, or they wouldn't add reserves as quickly as they had been. And so because, again, what the federal funds rate is, it's the rate banks charge each other for loans of reserves. If there's fewer reserves available, they're scarcer, and so how much do you got to pay to borrow them? The price goes up, so the interest rate goes up, so the Fed funds rate goes up. So again, if people remember, like if they took an economics class in college, generally speaking, this is the way it was up until 2008. When the Fed wants to have loose money, it buys assets that, by the accounting, creates reserves into the system. Banks now have more reserves to lend out, and so the interest rate on them goes down. If the Fed wants to tighten, it sells off assets from its balance sheet that absorbs reserves or destroys reserves, sucks it out of the system. There's fewer reserves, so therefore they're scarcer and interest rates rise. So that's why there tends to be a connection. But you're right. In principle, the mere fact of higher interest rates per se doesn't really directly relate to prices. Like, those are conceptually distinct things. It's just when you have a central bank operating the way the Fed did up until 2008, it tended to be the case that when the Fed raised rates, the way it did so was something that also would tend to tame price inflation, because it was basically sucking money out of the system.
Okay, so commercial banks have reserve requirements. And in the old days, when they wanted to make new loans, sometimes they might overnight have to borrow from another bank in order to make sure they had enough reserves not lent out to meet their reserve requirements. And of course, they have capital constraints beyond that. That's a separate question. But since 2008, commercial banks have been pretty flush with reserves because the QE program of buying of assets, treasury and mortgage-backed debt, has hugely inflated their accounts at the Fed, and now with this accelerated round of asset buying since COVID started, excess reserves, and I'm quoting here from the Fed's website, have gone from 1.75 trillion in the beginning of 2020 to 4.2 trillion now in the beginning of 2022. So I'm not sure that these banks much need to lend to each other overnight. If they're flush with reserves, they've got enough for their requirements.
Right. And so there's a few things going on. So one thing, let me just mention before I forget, is the Fed actually abolished reserve requirements. I think it was in 2020. It was after when the COVID stuff hit. There was one of the announcements they made. It was like on a Sunday or something that they were phasing out reserve requirements. So, but up at that point, it wasn't a big deal because you're right. It had been a moot issue for years at that point, and so they were kind of just acknowledging reality. And so yes, what they did back in the fall of 2008 was they started this new policy of paying interest on reserves, precisely for the reason you mentioned, Jeff. That so they wanted to divorce the size of the Fed's balance sheet, like its decisions about how much to spend on acquiring assets, because they wanted to bail out the mortgage-backed securities and so on, and also I think buy a lot of treasuries to monetize the debt that the Obama administration was running. The deficits. So, but they wanted the flexibility to make interest rates as an independent decision. Whereas, like I said, up until 2008, the two kind of were mirror images of each other, that the lever you would use to change interest rates was by buying or selling assets. So they wanted to make those different decisions. And so that's why in the fall of 2008, they started paying banks interest if they kept their reserves parked at the Fed. So what that effectively did is it allowed them to put a floor on the federal funds rate, right? Because if the Fed's saying, leave your reserves parked with us and we'll pay you 50 basis points, 0.5%, no bank is going to lend out its reserves to somebody else overnight for 0.4%. Why would you do that when the Fed's giving you a guaranteed 0.5, right? So it put an effective floor under that. So then the Fed, that gave it the freedom to buy more assets and flood the market with reserves without pushing the federal funds rate lower than it wanted it to be. And so one implication of that is now when the Fed starts to raise rates, and this goes back to your earlier question, Jeff, as to why maybe raising interest rates isn't really the same thing as tightening, especially in this environment now. It's really not clear because the way the Fed is raising rates lately is it's not selling off assets and absorbing reserves out of the system the way it would in an old textbook. Now, when the Fed wants to raise rates, it's just changing. It's increasing how much it pays banks to keep their reserves parked at the Fed. So it's not sucking money out of the system. So that's one way of seeing how, if you think, inflation's everywhere and always a monetary phenomenon, the Fed, by raising rates, is not reducing the amount of money in the hands of the public directly, the way things work right now. And so that's another way of seeing that, yeah, this is a different environment altogether.
Well, when we have the elimination of reserve requirements in response to COVID, among other things, and we also have the Fed funds rate, the amount of money banks can make by parking their money with the Fed, well below inflation, you would think that those two things would result in an orgy of lending because you don't have any reserve constraints and you want your money out there making an interest rate, charging people an interest rate that's more approximating inflation.
Right. So, I mean, but the other issue too is credit worthiness and so on.
Sure.
So that's a thing too, that, yeah, especially like in the immediate wake of the financial crisis, when the Fed was buying all those mortgage-backed securities and treasuries and the QE programs and excess reserves went through the roof. It's true, the Fed started paying interest on reserves, and I would sort of joke to public, I'd give public presentations and say the Fed started paying banks to not make loans to their customers, and that's a true statement. But that's not the only reason those reserves piled up so high. It was partly because the banks were skittish and yeah, they were afraid of making loans after everything blew up in their face, and so they were being much more careful in what they did. So yes, there is that element, but you're right. Certainly, with the paltry what they're paying right now on the interest on reserve balances, you would think banks would look out into the market and see is there more lucrative opportunities for us.
Which I think relates to this idea that sometimes monetary policy is pushing on a string. There's only so much you can do. You can't force banks to go out there and just make loans willy-nilly in ways which they think are uneconomic or risky or whatever it might be. It doesn't always work that way, and I think this is one of the big critiques of a planned monetary system. A couple weeks ago, I did a short solo show with Keith Weiner, who is at Monetary Metals, and he points out in a tweet the other day a couple things about raising interest rates, which actually could be inflationary, contra Jerome Powell's sentiments and statements to the opposite. But he says, look, hiking interest rates, well, first of all, causes higher costs for every producer. Well, that's true. I mean, the cost of capital went out. The marginal producer in every market goes out of business, or some of the more marginal producers in every market go out of business, presumably those who are more highly leveraged or whatever, zombie companies, which is reducing supply. So those two things are not deflationary, they're inflationary. And he points out that we had rising rates in the 70s and rising prices. So it's not just a mechanistic tool available to the Fed. It's a little bit more of a hit and hope, I think.
Strictly speaking, even if you did want to work in the framework of, interest rates and what should the Fed do with its target rate, everybody agree, or not everybody, most economists agree that, the relevant thing would be the real rate of interest, number one. Like that would be, so yes, if price inflation is running at 10%, then the Fed, just to have a neutral interest rate, is going to be higher, other things equal, than if the CPI is only increasing at 2%. Obviously, that's an element. But beyond that too, economic conditions might change what the so-called natural rate of interest is, and so that that's a concept that goes back to Vic Sell. Mises adopted it in his work. Even mainstream economists use that phrase about the natural rate of interest. Now they mean something a little bit different from like what Mises or Rothbard would have meant by it, but they'll say things like, the natural, when the economy is slumping or whatever, the natural rate of interest fell from 5 to 1%. And so if the Fed cuts interest rates from 5 just down to 3%, it's actually just effectively tightened.
Right.
So they'll talk like that. In other words, because what the rate should be fell so much, and the Fed in practice only cut a little bit, that's a sense of like in which they might say it passively tightened or something like that. So yes, most economists, not just Austrians, agree it's not the mere act of raising rates. It's, strictly speaking, you are supposed to raise it to stay with, they'll think they fell behind the curve or something.
But what's so interesting here is, unless you were around in the 70s to have experienced the last really inflationary period in this country, I mean, here we have a situation where actual inflation may be rising faster than nominal yields, no matter what Powell does. So even as he's raising rates, real rates could be dropping in that sense relative to inflation.
Right. Yeah, exactly. Yeah. Especially, and two, it matters, strictly speaking, it's not even so much what's the historical clocked measure of price inflation looking backwards. It's what is it going to be going forward? That, how much higher are consumer prices going to be a year from now? That's really the relevant issue when I'm deciding if I want to make a 12-month loan of dollars, and then when I get them paid back a year from now, what are prices going to be like then? So that's, strictly speaking, the issue is looking forward. What's price inflation going to be like?
Yeah, and the 8.5 CPI, I mean, I think we all know it's higher than that. There's very credible commenters out there talking about how we used to compile CPI, some of the differences, and how we looked at housing and other things. So, and then you've got people like Peter Schiff and John Williams at Shadow Stats saying, hey, this could actually be 15, 20%. So then we're really in a more unprecedented period than ever, than even the 70s, in terms of the difference between nominal rates and inflation, right? In other words, in the 70s and early 80s, when people were paying 15, 18, 19% for a mortgage, you could also go to a bank with your savings account and get double-digit interest for parking your money with them. Whereas today, you can't get that on the savings side, but it sounds like we might sooner or later be paying it.
Right. I think you're right in that. That is an important difference between now and the late 70s, that environment. in addition to, like we say, the fact that back then, when Volcker comes in and raises rates, the mechanism he used, I went and looked up the numbers. It actually wasn't so much that he started sucking base money out of the system, but its rate of growth collapsed to almost zero for a period there. So that's what happened then. And so that's the kind of thing that Powell would have to do this time. And he is, to their credit, they are talking about, hey, we're going to have to stop these asset purchases and maybe even start letting the balance sheet unwind a little bit. But thus far, that hasn't happened. So there hasn't, like I say, the way they raised rates, was it back in March, was by increasing the amount they're paying on reserves. It was not through sucking reserves out of the system. And yeah, to your point too about the calculations, I've looked. People have asked me over the years with John Williams and Shadow Stats, and I went and looked. So I'm not necessarily saying that their cumulative figure when they say this is what the real inflation rate is. That is that the right number or not? I'm not necessarily saying that, but I've looked at the methodology he goes through, and it's all pretty plausible to me that he says this is the way they used to calculate stuff. This is how they do it now, and notice it's biasing it to be a lower number. And for people who are curious, it's stuff like they'll make hedonic adjustments, right? So it's not just looking at what's the sticker price of a new car year after year, and then automobile prices are rising, but they'll say, but the car you buy now is a better thing than the car you would have bought last year. And so even though the sticker price goes up 7%, because you're getting 2% more car, it only really went up 5%. So they'll do stuff like that, which in principle is not a crazy thing to do, but it does give them a lot of flexibility because you can always tweak stuff like that. So if there's an incentive to kind of contain the number, like, ooh, it's coming out at 9.2, is there any way we can shave that down to 8.5? There's stuff they can do when they're not lying.
Well, and also in the Volcker era, I think he had more willingness to risk or even cause a recession in order to fight inflation and go against, to an extent, Jimmy Carter and Ronald Reagan in doing so. There was a nasty recession, 81, 82, I guess. So I'm not sure we have that political will anymore.
Right. So I think there's that issue, and also I don't know how you'd go and quantify it and try to see is this real, but my feeling is that the economy is much more precarious right now, and that it's much more addicted to low rates than they were they were addicted to easy money in the late 70s, and the shock that it would cause if they really jacked up rates now would be a lot more painful than what happened back then. And back then, keep in mind that up to that point was the worst recession since the Great Depression, what they had in the early 80s, at least is gauged by like unemployment and things like that. So, I mean, that was pretty painful back then. But hey, you're right. They said this is what you need to do to break the back of inflation, and that's what they did.
Right.
And so, yeah, I'm saying this time around, I think companies are more levered, and those are maybe some of the statistics you could look at. Certainly, the federal government's debt, not just in absolute terms, but as a share of GDP, is way higher than it was in the late 70s. So, yeah, there's lots of things that would give if the Fed all of a sudden just pushed interest rates across the yield curve up, just a few percentage points.
So what can they do? How do we get out of this inflation? What could the Fed or what could Congress do on the fiscal side to stop this?
So it's there is. I like Murray Rothbard. He had in his book Making Economic Sense. It was a collection of essays, and one of them was myths, I think, about the economy, or maybe it was about fiscal policy, something like that. But one of the myths he listed was that deficits cause inflation, and then another myth was deficits have nothing to do with inflation. And so the subtlety there was to say, if the central bank didn't monetize it, right, just the fact that Congress runs a deficit, that per se is not inflationary. Just like if a company issues bonds and spends money to buy a factory, and its expenditures exceed revenues that year, that doesn't make prices in general go up, right? Because the money they're getting to spend on the factory comes from savers, lenders, people who bought the bonds. So same thing even with the federal level, just merely running a deficit, if there's no new money being created to finance that, then per se that's not inflationary. So what they could do, the flip side is they could run surpluses, and then if that was dovetailed with the Fed rolling off its balance sheet, so if Congress ran a $300 billion surplus, and then the Fed just, retired $300 billion off of its balance sheet, there's a sense in which it would be like the Fed destroyed $300 billion of the government's money, So it's almost as if you just think about it intuitively. If the government, instead of spending the money, just piled it up in $100 bills and then lit it on fire and just burned the money. And so now they couldn't spend it because they burned it, but that would make prices lower than they otherwise would be because now there's $300 billion fewer dollars in existence, right? So that's kind of the way fiscal and monetary policy could work together. Whereas if the Fed just were to let the balance sheet shrink, and that shrinks the money supply, but Congress didn't run a surplus, then there's a sense in which it would be making the pain, like other entities would have to be the ones that would somehow have to, bear the brunt more directly. So I guess that's one way of looking at it.
But there's no way to vacuum up all that stimulus that's out there, that $4 trillion. That's out there in people's accounts. I mean, might have changed hands since it was paid by FedGov, but it's out there now. I mean, it seems like other than a radical reduction in spending on the fiscal side, real austerity, and that's what it would take to have even a tiny surplus. I mean, the deficit in 2020 was almost double what Congress brought in or what the Treasury brought in that year, and then the first year of Biden, it did come down, but there was still an enormous $1 trillion plus deficit. So I don't see how anytime soon on the fiscal side they start running these surpluses, which allow the Fed to basically start rolling things off or reducing its balance sheet. I don't see that anytime soon. So
could I just spell? So yeah, you're right, but we're kind of saying the same thing from different angles. So I'm saying mechanically how it could work in terms of the accounting is if the government cut its spending such that it had a $300 billion surplus. So everybody else is still paying their taxes the same, right? So you're right. The money right now is out in the hands of the public. All the stimulus checks but people still have to pay taxes, either through the corporations or whatever, or directly. So now that some of those dollars go to Washington, go to the IRS. And then the Fed says, okay, we got $300 billion in bonds coming due. And then the Treasury hands over the $300 billion and says, there you go, we're square now. And then the Fed says, okay. And then that money just disappears.
Right. Okay.
And so that's the way you could do it. So it's not making any household or corporation have to tighten its belt. And you say, well, where'd that $300 billion come from? And it came from, the government running a $300 billion surplus, which in our example is coming from them cutting spending. If they just raise taxes to do it, then yeah, that would impose the pain on everybody because now they got to pay more in taxes. So that's the way they could mechanically vacuum it out. But you're right. So if you're saying, yeah, but politically, do they have the will to cut spending that much? And there still would be pain from people who were used to get, who were expecting to get that government spending.
Yes.
It would hurt them in the sense, but it's not that money would be getting sucked out of their checking account. It's just money they expected to come in would not in fact come in.
So that's a good explanation, I think, mechanically of how you could do this, of how it would work. What's the more likely scenario? Is there any way that because of the dollar's status as the world's reserve currency, that we can kind of, get by and reduce inflation, have sort of a song and dance just because there's always a market for treasuries, always a market for dollars? I mean, does Powell have a realistic shot, given what he's got available to him politically and otherwise to get this thing under control, or do you think this is the new normal?
I think it's the new normal because the fact of the dollar's reserve currency status, I think, is what has enabled us to have such incredible rounds of QE without price inflation domestically, hitting sooner. In other words, it was the willingness of the world to absorb dollar-denominated assets, especially in the wake of the financial crisis, that allowed the Fed to print without apparent backlash. And so the only way now that the dollar's reserve currency, it would be if somehow Powell could convince the rest of the world that, no, we actually are going to be more responsible going forward. So you want to hold more treasuries, and then if they believed them, and then the rest of the world increase their demand to hold dollar-denominated assets, then yeah, that would make our inflation problem lower, even without the Fed doing anything with the money stock, because now that would increase the demand to hold dollars around the world, and that would take pressure off of our prices. But it's difficult to see how could they do that unless they announce some radical new thing like we're going to tie the dollar to gold or something.
So what do you think progressives like Krugman would suggest? Do they think that this is going to solve itself and Joe Biden's going to get reelected? I mean, what's their cure for all this?
So I don't know what Krugman actually thinks in his head, but in terms of his columns, yeah, the last one I checked in, I haven't checked on him recently, but he thinks that as of December at least, he was saying this is still transitory. It's less transitory than we thought, and so he did say he was wrong, that that inflation had kicked up a lot more than he thought. He was still being kind of smarmy though, saying, "Oh, the economists who got it right for the wrong reasons." Like he literally said that, right? So it can't be that my opponents were right. It was just they got lucky. But yeah, he still did think there were going to be bottlenecks that were going to ease up. To give you an example, more recently, Jeff, just a couple days ago, so Justin Wolfers tweeted out, "A lot of headlines today about inflation at 40-year high. We have a nice test of whether the media is symmetrically interested in good news, because in the next month or so, it's likely that unemployment will hit a 50-year low. Will this attract as many breathless headlines?" Right, so that's the way he's playing it. And Dean Baker was saying that the March figure that you alluded to, Jeff, is bad, but the gas prices are going to be lower in April, so that's going to come down. And then they said, yeah, there's still a lot of supply chain issues, but those are gradually going to get worked out. And he says data on shipping costs suggests that we'll have more good news in this sector in the months ahead. Right, so these guys who would tend to they are progressive, and Dean Baker I didn't remember him being as partisan, but he does seem like he's pretty much, carrying water for Biden right now. But that's the way they're handling. Yeah, they keep stressing that, hey, there's silver linings here, and that, yep, a lot of this is supply chain stuff that's going to gradually work itself out. There was a huge surge in energy prices, partly because of Ukraine. That's a one and done. That's kind of the way they're handling it. So, they're not saying it's going to be perfect, but I think they are saying the worst is behind us. But again, a lot of these guys back in the summer were saying the worst is behind us when inflation was just under 5%.
Right. And I think we have to understand that, first of all, a lot of them view inflation as a good thing. If a little bit of inflation is a good thing, then 8% shows that we have a roaring economy. A lot of people believe that. And a lot of people believe that government spending is not inflationary, that it drives the economy. I think we just have to accept that there's a huge disconnect there. And I don't know how you reach someone like a politician like Nancy Pelosi, for example, who says, "Oh, no. Government spending actually reduces inflation." I mean, that's just the kind of statement that is so mismatched. There's not much you can really do about that. I mean, you're talking about an alternate universe. I was reading Per Byland's thread over the weekend about inflation, which was really good. And one thing he pointed out, I thought he made a good case, is that the classical definition of inflation is an increase in the money supply. So if you just look at it that way, he says the point of Austrian economics is to help you understand how the economy works. And so when we've got all this complexity, you just mentioned all these things that these apologists are saying. Well, we've got Ukraine, and we've got gas, and we've got supply chain, and we've got unemployment. So this idea that it's this multi-factored thing. And Mises talks about this. He says it's not like a tragedy or a storm that comes along. Inflation's a policy. And Per's point is that our job is to isolate it and to say, look, we can go back, and when we have the single cause of monetary inflation, it becomes easier to trace and easier to think about what's happening. So what we really have to do is look at prices as the symptom. Rothbard talks about this. We don't care about the money supply per se. We don't care about prices per se. We care about the purchasing power of our money, right? If everyone makes 40 grand and a car costs 40 grand, that's bad. If everyone makes 40 grand and a car costs 20 grand, well, that's a better thing. So what we have to do, says Per, is we have to look at consumer prices and try to think about or understand what would they be absent these monetary interventions of the last 2 years, or the last 10 years, the last 30 years, however you want to view it. And I thought that was a good way to look at it, is that prices will go up and down based on all kinds of factors, including, of course, supply and demand. But when we isolate money creation and monetary stimulus, that gives us a better, clearer worldview, I think.
Right. And in case some viewers don't know this, that it used to be the case, certainly on the classical gold standard era, where like there might be a war and the government would temporarily suspend specie redemption, right? So like in the US, the dollar could no longer get you gold and silver if there was a war going on. And then they would print more dollars and you'd see prices rise. But then after the war, they would stop and they would try to get back to parity. It might take them a few years to do it. And you would see the price level would actually come down. And that's why over long stretches, the dollar roughly maintained its purchasing power. For like 100 years, how much could $10 buy you in terms of goods and services? It was roughly the same 100 years later, for the stretch. And so it wasn't the same year to year, but it was largely the same. And that's the way it worked. And something like that, I think, would have happened, for example, going into after the 2008 crisis. There actually was a period, it was in, I think it was October and November of 2008, where the official CPI went down. Like the price level actually was falling, and then finally it bottomed out and turned around and started rising again. So I think, had the Fed not intervened, prices would have come way down, not just house prices, but the price of gasoline. Well, the price of gasoline did come way down, but the prices in general. And you're right, because Keynesian economists have trained the public to believe rising prices are good, just as long as we don't overdo it. Mm-hmm. That falling prices are supposed to be horrible, when no, that's not obvious. Why would that be? That makes things cheaper, so there is that benefit. So you're right that when people would say, aha, you guys were warning about massive inflation, and apparently yes. So if I made some predictions that turned out to be wrong in 2009, 2010, but it's still true that what the Fed did by dumping all that money made prices higher than they otherwise would have been. It's just, had the Fed not done that, they would have fallen.
Right.
And then that would have made things cheaper for people. So it is interesting that what people are saying, mainstream economists, is, hey, the Fed should make things more expensive.
Right.
And that's, when you're thinking about it like that, it's not obvious that that's going to help us.
Right. And when you use Pear's rubric of, think about prices and how they would be absent the government's monetary intervention, that helps you think about, well, let's say consumer electronics, just because of technology. A DVD player goes down and down and down in price. You can get one for $30 now if anybody wants a DVD player. So the question is not just how fast prices are rising, but whether they would have fallen. Not just would they have risen more slowly, would they have actually fallen, right? That's the great unseen in all of this. And Bob, I can't help but think that the cure to all this, the solution to all this, is a terrible recession, maybe a depression. I mean, I don't know how else we put the brakes on government spending, which, as you point out, a lot of people rely on, and Fed monetization of debt, which a lot of people in the financial markets rely on. I mean, both those groups are awfully dependent, and I don't see how you change or stop this current path without a very painful and intentional correction.
Right. I mean, I think that's inevitable, especially if you're an adherent to Austrian business cycle theory, which says these artificially low rates, all this credit expansion, as Mises would call it, money that's being lent out that wasn't, really attributable to genuine saving on the private sector's part. That has spawned a bunch of malinvestments, right? So there's a sense in which there were a lot of investments, capital goods were made, long-term projects were started for which we don't have adequate real savings to finish all of them. Mm-hmm. And so there has to be a bust. It's not physically possible to continue in this path. And the way that will manifest itself is interest rates might rise, things like that. But, in terms of real things, real capital goods and such, that, right now we're in an unsustainable capital structure because of years of malinvestments guided by bad Fed policy. So, in that sense, a crash is inevitable. It's just a matter of how bad is it going to be, and are they just going to get it over with and let it happen? Also, too, I'll stop there. I think that's your point. And the other thing too is that what would have happened is in a more or less inflationary environment if prices either stayed the same or, like you said, even gently fell over time. Because there were periods in U.S. history where that happened. There were stretches in the 1920s, for example, where prices certain goods would gently fall. And so notice that makes it feasible for people to actually hold cash. And maybe not literally money tucked under their mattress, although they could if they wanted to, but things that were very liquid, close to just holding money. And whereas when prices are rising, even just 2 or 3% a year, consumer prices, then it's kind of like, oh, you're stupid. You wouldn't want to keep your money in cash. But then that forces people to make more specific investments. And so there's a sense in which, people can be more liquid and defer to others, right? That it's kind of thing where if you're just a regular household, maybe you should just keep your money in a savings account.
Yeah.
You know what I mean? Like maybe you shouldn't be having to decide which equities do I want to buy, or do I want to buy real estate in Australia?
Yeah.
Things like that, because I expect this big. So that's the thing. Just because prices are rising doesn't all of a sudden give more investing expertise to average people. And so it spawns more mistakes, or the phrase people use is a search for yield.
Yeah.
Right. And so, that's, you shouldn't ignore that. That's a real thing. And it's not good if people are feeling that they're taking on more risk by investing in specific things because, I can't stay in something more liquid because inflation will kill me if I do that.
Yeah, it definitely distorts the economy across the board. And I think that we've probably got some unpleasant times ahead of us. But all that said, that's the show for this week. We are going to link to a couple of various chapters in Bob's Monetary Mechanics book, which I recommend you pick up. Also, if you come see us in Orlando on Saturday in the middle of May, go to Mises.org/events. Bob and I, along with some other people, will be there, and all attendees will get a copy of his book, which is really a great one-lesson history explanation of money, banking, interest rates, you name it, gold standard, Bitcoin, Fed policy, just an absolute course in money, all contained in one book. So look for that at Mises.org/events. And Bob, great to talk to you. We'll be back with everybody next week and a new show. Thanks very much for watching.
Check back next week for a new episode of the Human Action Podcast. And in the meantime, you can find more content like this at Mises.org.